The best way to invest in real estate is through something called a real estate investment trust, or REIT for short. While you could also buy property yourself, there's a lot of problems that comes with that, including collecting rent, managing the property, dealing with tax issues. Instead, when you go with a real estate investment trust, you have a property investor, someone seasoned in this sector who can do all this for you. And instead what you do is you simply purchase the REIT from a stock exchange. You can also get a basket of REITs via an ETF. But let me just go forward and talk about the benefits of a REIT over buying property yourself. First, there's no long-term contracts. Because a REIT is essentially a stock or acts as a stock, you can buy it any time and sell it any time. It's not like buying a house and then dealing with the regulations for when to sell that house, listing the property, and so on. In addition, you don't have to manage the property yourself. Everything is done for you. All you do is purchase the REIT as a stock, hold it, and sell it when you're ready to sell it. In addition, they give you dividends. Most of the property's rent is redistributed to you as a dividend, so it's a sort of fixed investment that also gives you capital return. So you get dividend yields, and capital return. In addition, you're outsourcing the analysis of properties to someone who does this for a living, who's probably better than you are at it, objectively, because that's all they do all day long. Finally, there's no financial barrier for investing in a REIT, whereas to buy property, of course, you need a large sum of capital. Anyone, even with a small amount of capital, let's say even $500, could buy into a REIT and benefit from the dividends, get a portion of the dividends through that REIT, regardless of how much you're going into. So let's look at the top 5 REITs and REIT ETFs that I believe will do well in 2020, and I'll give you the basic details, what that REIT entails, and the dividends that you can expect to collect on them. We'll also look at the charts. If you don't know anything about technical analysis, there's a pretty useful website called stockta.com. You just put your ticker in here, and it'll give you the details. It'll show you the chart. It'll give you an overall sentiment analysis based on price action, and down here you have technical indicators. The summaries are simply listed in table form. So let's go through these 5, and we'll start with REITs, the Residential Real Estate iShares ETF. Now, ETF, if you don't know, is simply a collection of stocks that's put into a portfolio, and when you place money into this ETF, you're essentially buying that portfolio. Now, the residential ETF, capped ETF res, isn't exactly a 100% residential ETF. In other words, you're not buying simply multifamily properties and stuff like that. It's more diversified than it seems based on its name. It's actually more of an ex-commercial ETF. In other words, you're not buying properties that are set up to create income. Instead, you are buying the other types of properties, such as offices and residential properties. The focus is on residential properties, but there's more diversification here than the name would imply. Dividend you can expect is around 3%. It's actually 2.6% at present. And based on my seasonal analysis, I have the best entry point. By the way, these November, December entry points are for 2019. So if you are to find yourself interested in res, best buying point is near the end of November or the beginning of December. So we'll take a look at that chart. You can see that we have a channel upward, and pretty much everything is bullish, technically. The second ETF route, which is more general, is more diversified than res. This is a very popular real estate ETF. Their ticker is IYR. You get pretty much the whole real estate market. And the dividend is the same as the residential real estate market. Entry point is a little later. The end of December or the beginning of January tends to be where it starts to pick up. Now, deciding between these two, whether you want one that is ex-commercial or more diversified, depends on you. The reason I am, and you're going to see this later, the reason I am more akin to focusing on the residential ETFs at this point is because we are more or less near peak growth in the economy. And if you look at the leading indicators, leading economic indicators for the U.S. economy, we're pretty much peaking, which means that we're going to see businesses starting to have problems generating excess returns in the future. Therefore, going with residential properties, not commercial properties, is less of a gamble, simply because if you are focusing on a residential ETF, you're getting properties that are going to be in demand regardless of the economy. For example, you might be purchasing properties that are in a college town because people are not going to stop going to college simply because the economy is poor. You're always going to have a population boom in that area. Rent prices probably aren't going to change that much. Whereas for a commercial property, if the economy is not doing so well, the profits aren't coming in as easily. You're going to have a lot less competition. You have businesses dying down. You have fewer businesses starting up. So it might be a bit safer in 2020 to go with something more residential. But regardless, you have these two ETF options. And you also have individual REITs. So the next three are individual REITs. These are not exactly the most popular REITs, but based on what I've looked at, I think these three will do particularly well in 2020. The first is Sun Communities. Ticker is SUI. This is a residential community ETF. What they do is invest in manufactured housing, which is essentially creating a home, but not on a specific property. It's building the home, moving the home to a property. That's what they are investing in. And they are also investing in recreational vehicle communities. The dividend is quite low, but this is a pretty safe REIT. By the way, we should probably look at IYR before we get down to these individual REITs. IYR, again, is that diversified ETF. If you want to look at this chart, it looks pretty much the same as RES. The only difference is right now in the short term, we have a very bearish stochastic signal, which means that this ETF might be overbought. You might see it fall back a bit before it continues upward. On to SUI, like I said, the dividend is pretty low, and when you see a low dividend for a REIT, it's usually because lots of people want that REIT. It's popular, seems safe, so it's a risk-reward thing. You're not going to get a high dividend, but it's going to be a bit safer. You can see again, we have very strong technicals in pretty much every aspect. We have an upward channel, the stock is moving up, but also you don't need to worry so much about small dividends if you believe that this company will continue doing well, because you have that capital appreciation as well. The dividends are great, but if the stock goes up, you've also made money by gaining appreciation in that stock price itself. The entry point for this is near the end of November or the beginning of December. Very similar to the general ETF, the general residential real estate ETF RES. Moving on to a higher dividend is Armada Hoffler. This is a diversified ETF, or not ETF, REIT. So they invest pretty much in any type of rental property. Offices, grocery stores, housing. They focus on the eastern side of the U.S., highly densely populated areas where populations are growing. And you can see that the dividend is quite a bit higher here. That would imply that there's higher risk, and of course there's always going to be higher risk when you get a higher dividend. But if you look at the chart looks pretty good. We also have this upward channel. We just arrived above a strong support level, which means that the stock is unlikely to fall under 18.14. Again, the technicals here are strong, but because of the bearish stochastics, we might see a pullback and a testing or retesting of this support level. The buy-in point here is just like the generalized ETF IYR, late December or early January. Finally, a more risky ETF would be Redwood Trust. This is a mortgage ETF, which means it's not buying properties outright, but it's buying debt. It's investing in mortgages. So you're getting that extra risk that comes with buying debt, and because you're taking on that extra risk, you get this risk premium via the dividend. It's a 7.3% dividend, which is quite high. But you can see the chart is a little more messy. It's trending sideways for the most part, and you have a lot of bearish or very bearish signals, but you also have some bullish signals. It's more of a gamble, but if you like that dividend and you think this gap here will fill, for more on gaps, candlestick gaps, look at my other courses, other videos. But I think this is a more high risk one, but it should do well. And the entry point here is a bit later, however. You'd be looking at early January or late January or early February as your entry point. So these are my 5 suggestions for people interested in REITs and looking to hold a REIT, or at least diversify their portfolio, perhaps gain some fixed income holdings for 2020.